I like the look of a lot of companies at the moment. We've just had a lot of reporting. We've just gone through a big reporting season. You're now seeing the full reporting season in the US as well. You're seeing a lot of really good quality AIM companies with viable business models that have demonstrated that they can perform, having seen their share prices really sink. The difficulty, I think, with a lot of assessing things has been the nature of adjusting earnings as well. But if you can strip through all the adjustments that people are coming up with and look at the cash flow, the cash generation of many AIM companies, small and larger ones, have been really quite good, and their balance sheets are in pretty good shape. Even if they have debt, they have terrific cash generative potential. And that's what people should be looking at. Two examples recently. RWS Holdings is a stock we've held for a long time. It's in patent and language translation. It's got a localization services business. The cash flow yield on that business is circa, I think, 8% now. Hello, and welcome to this first episode of the Fundamental Asset Podcast. My name is Chris Boxall, co-founder of Fundamental Asset Management. And today we'll be covering delistings, dividends on AIM, and several specific companies, including Learning Technologies, RWS Holdings, and iEnergizer.
Hello, Chris.
Hi, Lee. Nice to talk to you again.
Been looking forward to this first episode of the Fundamental Asset Podcast. I've seen a lot of companies delisting in 2023. iEnergizer has just announced its delisting, circa 500 million market cap, and the share price has dropped 90%. How can investors avoid these types of left field shocks?
It's a really interesting one. I haven't seen a decline as rapid and as severe as this from such a big company. How does one avoid it? You can't. There's no foolproof way of avoiding it. What are the criteria of this business? It was 83% owned by the founder. So clearly at a dominant position, he could effectively do what he likes. The company is an offshore registered in Guernsey, but there are a lot of AIM companies like that as well. A lot of good ones. A lot of investment companies are domiciled in Guernsey and the Channel Islands, so it shouldn't necessarily put you off. Clearly, this dominant shareholding is a situation. However, on a positive, a lot of people always want to invest in family-controlled businesses. That's a real positive. You're very much aligned with the main owner, but they can, in this instance, and they have done what they like. When this sort of thing happens, you have a lot of hide say, oh, you should never invest in a business with such a high insider ownership. This thing's been on the stock market for a decade, I think, or so. It was readmitted a few years ago, but prior to that, it was on the stock market. The founder seemed perfectly happy. And contrary to that, I and many other managers hate founders selling down. I don't like them selling down at all. So that would be viewed as a negative when they cash in too early. But yeah, maybe this dominant position was a bit too much. But why does everybody just desert? When it was delisting, was yielding circa 6%. There's no indication at the moment whether the founders are going to commit to the dividend payment. And let's assume he does. You're still going to pick up a huge yield. Based on the 70% share price, or 90% of the share price decline, it's bounced a bit. There are some traders in there now. But based on the 90% decline, I think if the dividend was going to be committed to, the yield was touching 80% dividend yield by that point. So what it gets me, and it's happening time and again, and this is just really an indication, people just bailing out. So you've got a whole huge number of shareholders saying, we can't hold listed companies, we've got to sell instantly without thinking. It's like lemmings. It's really diabolical. And a lot of the other delistings have been structured around management going to private equity and taking companies off the market. In a few years' time, we're going to see these very same businesses probably relist at multiples of the value that they delisted at. And so shareholders can display a bit of patience and hold their nerve. I think they could do a lot better than just taking some quick, cheap money, albeit that this delisting was somewhat unusual, that you haven't had much communication, so you don't know what's going to happen as a private company. Some delistings, or we'll say private equity takeovers, it's almost better if shareholders, stock market shareholders can engineer a position in the private vehicle, if they're prepared to hold shares in a private company. And remember, it's worth remembering as well, for those interested in AIM shares for inheritance tax planning purposes, the benefit remains, the IHT planning benefit remains, whether it's a private company or listed on AIM. So they're not going to lose the tax planning benefits. It's private. They'll lose the liquidity to be able to readily sell the shares should they want to. But a little bit of patience could potentially go a long way.
That's really interesting. So even if the company delists, then they still benefit from the IHT tax break.
Absolutely. If it delists from AIM and goes to in private company status, yes, they do. The IHT break is based around the business relief rules, which were put in place for private family controlled companies to not penalize the passing down of the ownership. And that's down to families on the death of the main owner. So yeah, the benefit remains.
Yeah, because inheritance tax had jumped over $1 billion just recently. So being able to obviously mitigate the inheritance tax and direct it to your family would be more beneficial than leaving it to the government.
Yeah, absolutely. Yeah. It's tax on top of tax. It's taxing your assets that have already incurred tax. So it's pretty punitive. And the IHT take has been going up consistently because the thresholds have remained fixed, other than the additional threshold around residential property, which is also capped at a total of $1 million for husband and wife. But other than that, the thresholds remain fixed. What's been happening that people's assets, core asset of their houses and properties, they've been going up and up. They just collecting more and more inheritance tax revenue. And there are a few viable ways of mitigating inheritance tax. You can give it away, you can spend it, but if you want to retain control over it, one of the best ways has been, despite the recent declines in AIM, investing in AIM shares. They're very visible. You're investing in typically growth companies that until the last year or so, 18 months, have been doing very well. They've been doing terrifically well. Clearly, you can also invest in the shares of private companies, or you can invest in EIS qualifying issues as well, which would also come with inheritance tax planning benefits. AIM has been a great source for inheritance tax mitigation.
What's the process then? I've got my portfolio. I'm getting to the end of my time and I'm thinking, okay, let's work out how we can leave the best amount to my family.
We can't give investment advice per se. If you came to us directly, the first question to ask, if you're an experienced equity investor and you've got an existing portfolio of stocks or funds, so conceivably you are. A lot of clients come to us, by the way, via IFAs, financial advisors.
Right.
They are advised, and we do actually often prefer that. But notwithstanding, we get a lot of direct clients.
Yeah.
We'd assess their wealth to see if it would be suitable. And based on the application, we would either deem it acceptable or viable to open an IHT account or not.
Yeah.
We do ask if clients list their assets, and we, in the context of their assets relative to the inheritance tax relief, we'll go back to them and say, look, is this really suitable for you? You don't seem to have many free assets. So it's very important for us to be comfortable. If they are, we go ahead and construct a portfolio, typically bespoke, diverse portfolio of qualifying AIM quoted companies. Not all AIM companies qualify. It's about 80% of the 800 or so companies on AIM qualify. And we typically pick larger, more liquid ones with a smattering of smaller ones as well, sub 100 million market capitalization, smaller ones.
Do many of these companies pay dividends as well? Because I'm sure at that end of the age bracket, dividends quite an important factor for investors to think about.
We're not overly wedded by dividend income for our main growth portfolio, but we're aware a lot of clients, if they move from where their existing investments are, maybe at risk of foregoing dividend income that's provided a bit of a comfort to them. We've actually introduced more recently a higher income AIM portfolio. This was created on the basis that we've seen dividend yields on good AIM companies really soaring. Clearly, it's the inverse of where the share price is going.
Yeah.
So good quality AIM companies that have really seen their share prices fall, the dividend yield has gone up. And you can pick up dividend yields touching 10% on some AIM companies. That's not to say they'll all be able to continue paying out. If you have a nice basket of stocks, that can provide for a few disappointers. And the ones that do also recover, you're going to see terrific capital growth as well. We've already seen that with one was yielding circa 4% and its yields back down to touching 3%. It's been performing very well. Despite the dividend yield, the appearance of the dividend yield, these are still growth companies. They're still small growth stocks. It just so happens that a lot of them are offering quite compelling yields at the moment. I would emphasize there are going to be problems. You're going to expect that some stocks are going to suddenly come out and say, well, unfortunately, we can't pay our dividends because we've got one problem or another. But this is why it's so important to have a balanced portfolio. Even if you have a worst case, a total wipeout in shares, if you have an iEnergizer kind of scenario where you've got a terrible situation, if it's one of 25, 30 stocks, it's no big deal. We don't like it at all. We hate having losers. But that controls the situation. The problem we often see is when clients fall in love too much with an individual stock, an individual company, It occupies all their mind, all their waking hours. And it's just no way to go. Yeah,
Yeah.
it's just too stressful.
How do you mitigate something like that happening to you and your portfolios?
We as a firm, when things get to 10%, we start trimming off. We don't like
You actually have a
listening.
strategy in place for
Absolutely. We have a strategy. It's about counterintuitive of running your winners.
Yeah.
And it means you're not necessarily taking stuff up. Unfortunately, that hasn't been the problem over the last 18 months. It's about mitigating losses. But 10% of the portfolio, more than 10%, we don't like stocks getting to that extent, and we will trim off. It can be even lower. For smaller companies, we don't often let them get beyond 6 and a bit percent because they generally start off as a smaller percentage of the portfolio. But there's no reason that private investors shouldn't employ that kind of methodology of risk control. The difficulty becomes with this running your winners, and suddenly you've got this all dominant position, this 20-30% hold in your portfolio. And I fear that this can start happening with a stock like we've seen recently, One Disco, the one that's been suspended.
Yeah.
And people can start seeing this boom time happening, and the price keeps going and going, and they keep running in it. And suddenly something adverse happens and it's fallen by worse, suspended. I remember several years ago, we invested in a company called AB Dynamics. It's a very nice, ticker's ABDP. It's a very nice engineering, automotive engineering, doing testing systems for cars and the automotive sector. And it's expanded into other areas, simulation stuff. It's got track testing facilities as well. But that was a very small company. And we always had it as what we call a satellite position on our portfolios. We didn't let it, typically that's 2.5% position. And it ran up very quickly, and we always trimmed off. And it subsequently has fallen a lot from highs. If we'd have run that up, clients would have had a very sharp correction, and it would have introduced a lot of volatility to portfolios. So that gives an example of probably a practical example of what can happen.
Yeah.
If you're having to do it for clients, as we have to do, to present that kind of volatility starts scaring them.
That highlights the difference between a fund manager and running your own portfolio, doesn't it?
Absolutely. There's a responsibility. I mean, it's their money, not ours.
Yeah.
And we would need them to feel comfortable, and we need to manage their expectations effectively, which is difficult. Recently, over the financial crisis, the FCA in its wisdom introduced this 10% decline rule. We were supposed to notify our clients every time the portfolio declined 10% or more. Sorry, not the financial crisis, over the pandemic, 10% or more. It just came in just before the pandemic. So you can imagine when the pandemic hit, lockdown, the stock market absolutely sunk, didn't it? And AIM in particular. So we were having to manage all these 10% notifications. That was a decline of 10% from the last time we had reported to our clients. Okay. So we had to report this 10% and maybe another 10% the next quarter. What we weren't obliged to do was inform the clients when the portfolios went up by 10% again. So, which AIM subsequently did. It had a fabulous first year of lockdown when everybody realized that a lot of these AIM companies were going to do very nicely. And it was just ludicrous. You're having to issue all these reports and worrying people potentially, or then reassuring them, but not formally having to tell them the other way.
Yeah, when you thought they'd have the other way as well. Very typical.
Stupidity, real stupidity.
Yeah. What are you looking at as any opportunities? Is there any sort of companies that you like the look of at the moment?
I like the look of a lot of companies at the moment. We've just had a lot of reporting. We've just gone through a big reporting season. You're now seeing the full reporting season in the US as well. You're seeing a lot of really good quality AIM companies with viable business models that have demonstrated that they can perform, having seen their share prices really sink. The difficulty, I think, with a lot of assessing things has been the nature of adjusting earnings as well. But if you can strip through all the adjustments that people are coming up with and look at the cash flow, the cash generation of many AIM companies, small and larger ones, have been really quite good, and their balance sheets are in pretty good shape. Even if they have debt, they have terrific cash generative potential. And that's what people should be looking at. 2 examples recently. RWS Holdings is a stock we've held for a long time. It's in patent and language translation. It's got a localization services business. The cash flow yield on that business is circa 8% now. It's made a lot of acquisitions. When it's raised debt, it pays it up incredibly quickly and turns into a net positive cash. I think the dividend yield's over 4%. Former AIM star it was. So this was until recently a billion and a 1.4 billion pound company, which is sunk below $1 billion in value now. And I think it looks compelling. To your point, you've got to look at the detail as well. And as I said, we focus on the cash. There's another large company which actually has a a common owner, a common majority owner as RWS called Learning Technologies. And Learning Technologies issued an announcement recently, an update. Inserted in the detail was an effective profit warning, but it didn't tell us. It didn't expressly point it out really that wasn't going to hit the numbers. So you had to really look into the detail. But aside from that sort of earnings waffle, if you looked into the cash flow of Learning Technologies, again, it looks pretty attractive at the current point. And the valuation is far more attractive than it was a year or so ago.
So this is presenting opportunities really, isn't it? And I guess that's representative by Deutsche Bank, by Numis?
Yeah, Numis.
Is this a trend? Do you think we're going to see this throughout 2023, takeovers, mergers?
Unfortunately, it is, and it has been. We've already seen several takeouts in 2023. We've seen the delisting that we referred to. And now the irony is we've got an AIM-listed corporate broker whose role is to support companies being taken out at what looks like a good premium. It's a 70% premium to what the share price was the day before. I think it's 400 odd million pounds. So it's a big AIM company, and it's an AIM company in the middle of listing other AIM companies and supporting other AIM and mid-cap stocks. And Deutsche had come along and acquired this 70% off premium. But look back a couple of years and the share price was higher than it is today. And even further back, it was much higher. So it's just a case of shareholders, again, I think, preparing to be bought out at the bottom of the cycle. Numis was yielding circa 6%. Yeah, they could have sat this out for a while, sucked in a few dividends over the next few years. Probably this share price will be multiples more than what the takeout price is. The UK investor base is failing to hold its nerve. That's it. They're running scared and just taking cheap money off the table.
I did look at the share price and it's at the bottom of its cycle, isn't it? If it reaches the previous highs, not only have they got the dividend, but they've also got the re-rate share price. They've got themselves a really good deal.
Absolutely. I mean, they talked about integrating Deutsche's other corporate broking bit into it. But you're right. Numis could have sat this out, held its place, continued to invest. When things do turn, when the market does turn, it could make hay and then subsequently pay some huge distributions. Because that's the nature of brokers. They generally pay out dividends. They know it. They acknowledge the cyclicality and they generally shove out some big dividends to their shareholders when they fill up with cash.
So do you think this is going to be something we're going to see more of during 2023?
I hope not, but I fear we will, yeah. I think there are some pretty good AIM companies, going back to an early point, going cheap.
Yeah.
And unless things start moving, I think private equity, which still has quite a lot of money, will take them out, which would be a great shame because we'll lose some good businesses. And in the meantime, it's going to take a while to replace them as well.
So with the takeovers, what's the risk to private shareholders then? Would it be a natural strategy to look for companies that potentially look ripe for a takeover?
Yeah, it's interesting to look for companies that are ripe for a takeover, but I would say companies that are ripe for a takeover are also got compelling valuations. They're being taken over because their valuations look compelling. And even if you apply a premium, the valuation still looks compelling, hence private equities taking over. At the moment, there are so many. That's the issue. There's no shortage of takeover candidates amongst big, mid-sized and smaller AIM companies. Just the small cap space looks at quite distressed levels in terms of valuations. You can fill your boots with potential takeover opportunities at the moment.
So as we bring this first episode to a close then, you are quite the optimist then, it would seem, from this conversation.
I've got to be an eternal optimist. We're fund managers and look to the future. So you should probably take what I say with a pinch of salt. But yeah, at the current level, a lot of companies in our book look quite compelling. And when we get new money in, which thankfully we've seen good commitment from new clients, we continue to buy. And I think actually in terms of AIM over the last few months, I think the inheritance tax planning investors have been quite bullish. They're coming in. We've seen good flows and long may that continue. I wish others would be, should we say, braver, notably some of these insiders that are willing to take cheap money off the table and just run away. But yeah, I'm quietly confident.
Well, that's it for the first episode of the Fundamental Asset Podcast with Chris Boxall. We hope you enjoyed it. And if this is the type of content that you enjoy listening to, then please subscribe and leave us a comment to let us know. And if you'd like to get in touch with Chris or a member of his team, then simply scroll down to the bottom of the show notes where you'll see all the links there, including the Contact Us page for Chris's website, Fundamental Assets. Simply leave a message in the Contact Us page and they will get back in touch with you. Thanks for listening and I hope you have a great week.